Have you ever heard people say, this stock's cheap or that stock's expensive, and not know what they meant? Well, in this video, I'm going to teach you what it means. So to know if something is cheap or expensive, we need to know two things. We need to know how much we're paying and what we're getting. One thing is not enough. For example, let's say I offer to sell you a car for $50,000. You don't know if that's cheap or expensive. If it's an old rusted out beater, $50,000 is very expensive. If it's a brand new Ferrari, $50,000 is very cheap. Let's have another example. Let's say we're at the grocery store and we see a turkey over here for $20. And over here we see ground beef for $8. Well, which one's cheaper? We don't know because we only know one of the two things. If I told you the turkey serves 4 and the beef only serves 1, then which one's cheaper? The turkey is. It's cheaper because we're paying $20 for 4 servings, or $5 a serving, whereas the beef is $8 for a single serving, or $8 a serving. So the turkey's cheaper, but we need to know both things, what we're paying and what we're getting, to know if something's cheaper. Well, it's the same for stock. We need to know what we're paying and what we're getting. The most common way to evaluate whether a stock is expensive or cheap is called the PE ratio. That stands for price to earnings ratio. And it's just a fraction where we have price or share price in the numerator and we have earnings or earnings per share in the denominator. So when you buy a stock, you're buying the right to some of the firm's profits. The profits associated with a single share are called earnings per share. We can use profits and earnings interchangeably. For the stocks, the same as for the turkey, we need to know what we're paying divided by what we're getting. So with stocks, we're paying the share price and we're getting the earnings per share. So the PE ratio can be interpreted as how much do we have to pay for the right to 1 unit of the firm's profits. In this case, a unit is $1. So we can interpret the PE ratio as how much does it cost for the right to $1 of the firm's profit. So if we have to pay more for $1 of the firm's profits, that stock's going to be expensive. If we can pay less, that stock's going to be cheap. So let's do an example. Let's say we have a TV company whose share price is $100 and the earnings associated with the single share or EPS are $5. So what would the PE of that company be? It's 100 share price divided by 5 earnings per share, or 20. Let's do another example. Let's say we have a company over here with a share price of 20 and earnings per share of 2, and a company over here with a share price of 10 and earnings per share of 1. Which company is cheaper? That's a trick question. The PE of this company is 20 divided by 2, or 10. The PE of this company is 10 divided by 1, or 10. So these stocks are equally expensive or equally cheap. I tried to trick you. This example is proof that you need to know more than just the price to know if it's expensive or cheap. So this one costs 20, this one costs 10. One is not cheaper or more expensive than the other. They're the same. This one costs twice as much, but you get twice as much profit. PE ratios are related to what the market thinks about the future profits of that particular firm. If the market thinks the firm's profits are going to grow very quickly, its profits are going to be more expensive and its PE is going to be higher. If the market thinks the profits are going to shrink or grow very slowly, that stock will have a lower PE and be cheaper. An example of something whose profits are expected to grow quickly could be renewable energy or battery-driven cars, a company like Tesla. And an example of a firm whose profits are expected to shrink or grow very slowly could be a big oil company like Exxon. The world is moving from oil to renewable energy. So PEs vary across industries. You'll see on the screen here, different industries have different PEs. You'll see technology firms toward the bottom. This means the market expects technology stocks' profits to grow quicker than the average firm. PEs also vary over time. Now, just for the back of your mind, the average PE of a US firm over the last 100 years is between 16 and 20. So that means the average you'd pay for $1 of profits for a US firm over the last 100 years would be between $16 and $20. So put that in the back of your mind. That's some baseline you could compare different PEs to. So if you hear some company with a PE of 10, that would be cheap because it's less than the long run average. If you hear a company with a PE of 50, that would be expensive because it's way more than the long run average. PE ratios change over time. You can see on the screen here, over the last 3 decades, the PE ratios have been low or very high. You can see during recessions in 2001 and 2009 that PE ratios increased a lot. Why is that? That's because in recessions, profits decrease a lot. So if the profits in the denominator get really small, the PE ratio is going to get really big. So that's why you see the spikes during recessions. PE ratios also vary a lot within firms over time. You'll see on the chart here that Apple's PE ratio over the last 12 years has been below 10 at the lowest and above 30 at the highest. So for a good chunk of time, Apple's PE ratio was 10 or 11 or 12, and now it's over 30. That means not long ago, you could buy $1 of Apple's profits for 10 or 11 or $12, and now that same dollar of Apple's profits costs over $30. So there's lots of variation within a firm over time as well. So the PE ratio is the share price over the last 12 months or 4 quarters of profits. That's the regular PE ratio. There's also something called the forward PE ratio, which is the share price today over the next 12 months expected profits. Regular PE uses the last 12 months profits. Forward PE uses the next 12 months profits. It's forward looking. What does the market expect the profits to be over the next 12 months? So if you hear forward PE, think what the market expects the next 12 months of profits to be for that particular firm. People have also looked at PE ratios, and here I have plotted PE ratios on the x-axis, the horizontal axis, and the next 3 years stock returns on the y or vertical axis. If you tried to fit a line through the dots, it would have a downward slope. This means that lower PEs are associated with higher future returns, and higher PEs are associated with lower future returns. Right now, the market's PE ratio is higher than average. This might mean that future returns are going to be lower than average. I hope this video has been helpful, and now next time you hear someone say, that stock's really expensive, you'll have a way to evaluate it and know whether it's true. Keep in the back of your mind, the long run PE ratio for US stocks is between 16 and 20. So cheap probably means less than 16, and expensive probably means more than 20. If you thought this video was valuable, please click below and subscribe, and I look forward to seeing you in my next video.